Hey, it's Dave Knight here at 123daytrade.com. Thanks for watching. Thanks for being here. Today, I want to tackle the concept that I call average daily range, or what I like to call ADR, not to be confused with any study that's out there. This is totally and separate. It's the way that I determine ADR and how I look at it. Now, what I'm going to do today is give you the quick and dirty calculation of how you can get to it, but there is more to it than the number that I give to you today. I just want to give you something that you can work with, okay? All right. To review, over the last 2 days, we talked about R, and then we talked about R versus P. On day one, we talked about, just a summary review, we talked about defining your R. What does one R mean to you? What is that, I guess, for lack of a better way of saying it, your pain threshold? For me, it's 20 ticks. I don't want to have any trade per contract greater than a loss of 20 ticks. In other words, $200 plus commission cost, obviously. Along those lines, I want to make sure that when I have a winning trade, and now moving forward, R versus P, risk versus profit, that I want to take out more on the profit side than I'm willing to risk. And yesterday we talked about 20 ticks, and maybe we should be taking out 22 to 23. And then, as Dr. Tharp talked about, that 3R in our terms of looking at it, 60 ticks versus 20 ticks, maybe it should be 67, 68 ticks versus 20 ticks. In other words, 3P should be around, say, 68, 70 or greater when you're looking at it, like today. Now, that was the last 2 days, R versus R, define your R, and yesterday was R versus P. Today, average daily range. Now, when I first used to look at average daily range, I thought that's a cool concept. I just looked back, oh, there's 7 days in a week, we might as well just take it by 7. So how you determine it is you take the high minus the low of the market that you're looking at, and that gives you a range. For instance, yesterday's range was 57.61 to 55.66, a difference of 195 ticks in movement between the high and the low. So that's 1 day's range. And if you go back 7 days, that would give you a number. So you would go back 7 days, 7 trading days, and then that would give you a number, and you divide that by 7. I believe that, and not to go down the rabbit hole, that you should use 9. You should use 9 because of, well, I wrote about it a little bit. Just go to the blog and search what does Tesla and Gann have in common. So just, I guess if you would just put Tesla in the search box and Gann, you would come up with the article that I wrote. I don't want to go down the rabbit hole, but just suffice it to say, I like to look back 9 days. Now, the quick and dirty way of determining this is going back and taking that 9 trading days. Now, if you would go back and look at 9 trading days, the number that you would get in the crude oil market today would have been 1,013. If you divide that into 9, you'd come up with 112.6. You divide that again into 10, and you come up with 1.12. What does that mean? 112, 113 ticks of range over the last 9 trading days, okay? So that is average daily range, and what I use with that, so I said, 11.26, 11.3. In this case, that becomes your 1R for the trading day. You with me? We have 20 ticks. We don't want to be any greater than that. But today, the average daily range is actually low enough that we can have a 1R target or 1R risk component sitting at about 11 to 12 ticks, and we could go after, say, 14 or 15 ticks on the 1P side. And today, if I look back today on my spreadsheet, 1R, and this is my calcs coming out, so 1R was 12 ticks and 1P was 15 ticks. And 3P movement, like we talked about, I would be looking at 44 ticks of movement on the 3P side versus a 12 tick stop loss on the R side. So if you would take 44 and divide that by 12, you come up with 3.667. So in other words, greater than 3 to 1. That's what you want to look at when you're thinking about average daily range. Because on a winning trade, you're trying to what? The 3 rules of trading that I believe that you should have memorized. 1, cut your losses short. 2, let profits run. 3, take profits on the ride. Whenever you get the opportunity to get a 3P, or in other words, a 3 to 1 in any given trade, you lock it in if you can, or if it's going to go greater than you can get. So basically what I'm getting at is that you're trying to win a lot more on your wins than what you're willing to risk on your losses. I hope this helps you as it relates to ADR. The quick and dirty way, once again, to determine the ADR is go back 9 trading days. Look against the high of that market that you're looking at against the low of that market. That gives you the range for that day. Go back 9 days and then you get that number. Like for instance, I talked about the crude oil market was 1,013. Divide that by 9 and you came up to 112.6 today. So I hope that helps you. If I can answer any questions, feel free to write them in the box below. And just one way of looking at the market. Obviously, this works for me. Bottom line to this is that I want to leave with you as you've got to take more away on your winning trades than what you're willing to lose. All right. God bless. Take care. And by the way, on the next video that we'll be talking about, we'll dive a little bit deeper into the Gann Tesla relationship, the 369. All right. God bless. Take care. I'll see you on the next video I put together. Bye for now.